Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Snowflake.
If you find our talks useful, please consider subscribe, like, and comment underneath. Now, imagine finding out that the fastest growing artificial intelligence infrastructure company on Earth just had its stock price slashed by a third.
Yeah, slashed is definitely the right word for it.
Right. And you look at their internal ledger and the revenue is surging, like up 30%. But then you look at the actual stock chart and it resembles a company on the verge of bankruptcy. So that is the massive, glaring paradox we are unpacking today for you.
The visual of that stock chart over, the first few months of 2026 is just undeniably brutal. It really reflects a market that appears to have fundamentally lost faith in the narrative.
We are looking at a stock that is down 30.7% year to date. And we're talking late March 2026 here, with shares trading right around $174.
Which is a huge drop.
Exactly. And to put the severity of that punishment into perspective for everyone listening, the broader tech sector has only seen a minor dip, something like 5.7%.
Right. So it's a massive underperformance.
Right. So while the rest of the tech world is experiencing this, slight macroeconomic cooling off, Snowflake is being treated like a distressed asset.
Yeah, like it's completely broken.
Which brings us to the mission for today. We need to figure out the truth behind this disconnect. Is this a classic contrarian opportunity where you should be casually walking in to buy the panic? Or is this a value trap that's just going to keep burning anyone who tries to catch the falling knife?
And to answer that, we really need to completely detach from the emotion of the stock chart. You have to look at the mechanical reality of their fourth quarter fiscal 2026 earnings.
Which were surprisingly good.
Oh, absolutely. The market is pricing in a catastrophe, right?
Yeah.
Yet the company just reported an absolute beat across the board. I mean, product revenue hit $1.23 billion.
Wow.
Yeah, that is a 30% year-over-year increase.
I have to pause there because a 30% top-line increase for a company that's already operating at a billion-dollar quarterly run rate, that is staggering.
It's massive scale, yeah.
But top-line revenue is really only half the story. I mean, a company can easily grow revenue by 30% if they are recklessly burning cash on, marketing and aggressive sales incentives.
Exactly, which is the core argument the bears usually make. But the operating margins here actually dismantle that theory completely.
Oh, really? What were the margins?
Their operating margins hit 11% for the quarter, and the street was only estimating 7%.
Wait, how does a software company beat margin estimates by that wide of a spread? I mean, 400 basis points is not just a rounding error. Did they just, gut their research and development department to make the quarterly numbers look good?
No, they didn't sacrifice research and development at all. That 11% margin is actually a textbook demonstration of operational leverage in cloud software.
Okay, break that down for us.
Sure. So once the core infrastructure and the software platform are built, the cost to service the next $1 billion in revenue is significantly lower than that first billion.
Ah, right. Because the foundation is already there.
Exactly. Plus, they are actively utilizing their own internal AI tools to make their engineering and sales teams vastly more efficient. So they are generating way more revenue per employee now.
That makes sense.
And management has also reaffirmed their guidance for increased product revenue growth going into fiscal year 2027, which signals immense internal confidence.
Okay, so if the revenue is growing at 30% and the margins are expanding through this operational leverage, we really need to address the stock's massive gap down.
Yeah, the elephant in the room.
Right. And I want to clarify this for the listener real quick. A gap down happens when a stock opens for trading at a price significantly lower than its previous close. This usually happens because algorithms and institutional investors dump massive amounts of shares in after-hours trading.
Right. It creates a literal empty space, a gap on the price chart.
Exactly. So why did the algorithms trigger such a violent sell-off if the underlying numbers were this strong?
Well, looking at this setup, it's like walking into a high-end electronics store, right? And you see their best-selling, most profitable TV sitting on a 30% off clearance rack.
Right. You immediately wonder, is the screen cracked or did the manager just make a huge pricing mistake?
Precisely. And in this case, the initial sell-off was driven by a temporary panic over forward-looking consumption forecasts, which frankly are notoriously difficult to model right now with the whole transition to AI.
So it was algorithmic panic.
Yes, algorithmic panic that creates a severe technical overselling scenario. When an order book empties out that aggressively, the stock drops until it hits a fundamental floor, like a major support level.
And that's where we are now.
Right. As the stock stabilizes near 174, you're seeing institutional value investors starting to step in. They're looking at the 30% growth and the 11% margins, and they recognize that the underlying business is completely intact. They're capitalizing on that algorithmic mispricing.
The business is intact, sure, but to really understand the durability of that 30% revenue growth, we have to look under the hood at how their business model has actually evolved. Because, I mean, they aren't just selling cloud storage anymore.
Oh, no, not at all. That pivot is the single most important variable in this entire analysis. Historically, their whole identity was being the data cloud, right?
A highly efficient, secure warehouse where enterprises parked massive amounts of data.
Exactly, a storage locker. But today, they are actively transforming into the core operating system for enterprise artificial intelligence.
See, that is a massive conceptual leap. Being a secure storage locker is very, very different from being an AI operating system.
It is a totally different game.
Let's talk about how they are mechanically executing that transition, particularly with this Cortex AI offering.
Yeah, so Cortex AI is the main vehicle for this transformation, and the adoption metrics are staggering. Over 50% of their customer base is already actively using it.
Half the base, that's huge.
It is. We are seeing more than 5,200 weekly active users and over 9,100 AI-enabled accounts. But the mechanics of how Cortex works are what make it truly revolutionary.
No.
They've secured direct partnerships with frontier model providers, people like OpenAI and Anthropic.
Wait, let me stop you there. If I am a Fortune 500 bank or, say, a major healthcare provider, my biggest fear by far is data leakage.
Oh, absolutely.
So I am definitely not going to send my highly regulated proprietary data over the public internet to an OpenAI server just so a language model can summarize a report for me. It's too risky.
And that exact fear is what Snowflake is monetizing. Instead of forcing the enterprise to move their sensitive data over to the AI model, Snowflake brings the AI model to the data.
Oh, I see.
It utilizes this concept called data gravity. Because the enterprise's massive data sets already live inside Snowflake's secure perimeter, Cortex allows companies to just spin up instances of OpenAI or Anthropic models directly inside that existing walled garden.
So the data never leaves the vault.
Never. The AI computation happens right there on top of the proprietary data. They utilize something called retrieval augmented generation, or RAG, to ensure the model outputs are highly accurate and, most importantly, entirely private.
That's a great analogy, actually. It sounds like Snowflake used to just build the secure vault where enterprises kept their gold, their data. But by partnering with OpenAI and Anthropic, they've put a state-of-the-art forge right inside the vault.
That's a perfect way to put it.
The gold never sees the light of day. But from a business perspective, if a client builds their entire internal AI infrastructure using Snowflake's proprietary forge, doesn't that make customers highly dependent on them? Doesn't that lock them in completely?
It creates one of the deepest economic moats in modern software. I mean, in the tech industry, we evaluate moats based on switching costs. Snowflake currently has over 14,200 partners in their ecosystem.
Wow, 14,000.
Yeah. So if a chief technology officer embeds Snowflake deeply into their data pipelines, connects it to dozens of third-party apps, and then builds thousands of daily AI workflows on top of it, extracting that ecosystem becomes nearly impossible.
Because if a CTO gets frustrated, say, with Snowflake's pricing and decides they want to migrate to a competitor like Oracle or Google BigQuery, they aren't just migrating cold storage files anymore.
Exactly. They would be actively breaking their company's entire nervous system.
Ouch.
Right. To migrate out, a CTO would have to rewrite thousands of API integrations. They'd have to retrain all their customized AI models, disrupt daily operations for months, and take on just catastrophic operational risks.
So the logistical and financial nightmare of that migration heavily disincentivizes leaving.
Exactly. This technological lock-in beautifully insulates Snowflake's revenue base from competitors.
Well, the theory of a technological moat is compelling, but, theories don't pay dividends. How does this lock-in mechanically translate to the financial health of the company? Because a sticky product is great, but we really need to see that reflected in guaranteed cash flow.
Right, and to see that cash flow visibility, we have to look at the RPO metric.
Which stands for Remaining Performance Obligations.
Correct. Snowflake's RPO has recently surged to a staggering $9.7 billion.
Okay, for the listener trying to contextualize almost $10 billion in RPO, let's break down how that metric actually functions on a balance sheet.
Sure. So RPO represents revenue that a customer is contractually obligated to pay, but that Snowflake hasn't legally recognized yet on the income statement because the computing services will be delivered over time.
Ah, so it's a massive backlog of contracted future money.
Precisely. An RPO of 9.77 billion gives the company incredibly clear visibility into their cash flow for the next several years.
I am going to push back a little on the idea that this money is entirely guaranteed. I mean, contracts can be broken, they can be renegotiated or downsized. What happens if there is a severe recession and these massive enterprise clients simply stop running as many AI models? Does that 9.77 billion just evaporate?
It doesn't evaporate, and that's because of how enterprise software contracts are structured. These are legally binding, multi-year commitments, and they almost always include consumption minimums.
Sure.
So even if a client significantly scales back their computing usage during a recession, they are still contractually obligated to pay for a pre-negotiated baseline of capacity.
I see.
Obviously, a total corporate bankruptcy would erase the contract, but we are talking about Fortune 500 companies here. The baseline revenue is exceptionally secure.
Baseline might be secure, sure, but are they actually growing their usage?
Yes, and we can measure that through their net revenue retention rate, which currently sits at 125%.
Okay, the mechanism behind that number is crucial. A net revenue retention rate of 125% basically dictates that even if Snowflake's sales team went on vacation for a whole year, didn't acquire a single new customer, their existing customer base is spending 25% more today than they did 12 months ago.
Exactly. The customers locked inside the vault aren't just paying their minimums, they're dramatically expanding their daily consumption of these new AI tools.
And we are seeing leadership moves that really suggest internal confidence in that continued expansion.
Oh, absolutely.
The recent appointment of veteran insider Jonathan Bullier as Chief Revenue Officer is very telling. When an insider is elevated to lead the entire revenue pipeline during a massive technological pivot, it usually indicates they have looked at the proprietary consumption data, they know the adoption rates of the AI workloads, and they are highly confident they can execute on that backlog.
Yeah, they see the writing on the wall. And the fact that management subsequently reaffirmed their fiscal year 2027 revenue growth guidance entirely supports that thesis.
All right, let's pause and brutally evaluate the setup here. We have a stock that has tanked at 30% year to date, yet the product revenue is growing at 30%. Operating margins are crushing estimates. They have successfully brought generative AI directly to the enterprise data perimeter, and they have nearly $10 billion in contracted future revenue.
Right, the bullish case is very obvious.
Which means we must aggressively evaluate the bear case. What are the structural threats that could turn this into a value trap?
Well, the most immediate threat is a phenomenon we call the structural efficiency paradox.
The structural efficiency paradox. Okay, what is that?
It stems directly from Snowflake's business model. See, they do not charge a flat monthly subscription fee. They operate on a consumption-based pricing model, meaning customers are billed strictly for the compute power and time they utilize to run queries and AI model.
Okay, so it is functionally identical to a utility bill. A factory pays the utility company based on the megawatt hours of electricity the machines consume.
Exactly like that. The complication arises from Snowflake's own engineering success.
How so?
Snowflake aggressively invests in making their core software faster, more efficient, and better optimized. But because of their consumption billing, as Snowflake improves its product efficiency, a customer's complex data query that used to take 10 seconds might now only take 5 seconds.
Wait, so you're telling me that by engineering a superior, faster product for the customer, Snowflake literally cuts their own short-term billings in half for that specific task?
Yeah.
That is a brutal paradox. They spend millions in research and development to optimize the platform. The customer is thrilled because their workflows are lightning fast, and Snowflake gets punished with lower immediate revenue.
It is a brutal paradox, and it acts as a persistent drag on short-term revenue growth.
Is there any defense against that?
The long-term defense is the concept of induced demand. By making compute drastically cheaper and faster, customers are theoretically incentivized to run vastly more queries and build much larger, more complex AI applications, which eventually drives total consumption back up.
Right. If it's cheaper to use, you'll use it for more things.
Exactly. But the transition period where those efficiency gains eat into current revenue, That is a massive risk factor the market is struggling to price.
That explains some of the short-term revenue anxiety for sure. But I want to talk about a much larger, potentially existential structural risk, and that is hyperscaler rent.
Ah, yes, the rent bill.
Because Snowflake does not own the physical servers or the massive data centers their software runs on. They sit on top of the physical infrastructure provided by the hyperscalers, Amazon Web Services, Google Cloud, and Microsoft Azure. Snowflake has to pay massive fees these giants just to operate.
And that hyperscaler rent is a permanent structural headwind on Snowflake's profit margins. Every time Snowflake scales up, their rent bill to Amazon, Google, and Microsoft scales right along with them.
But it is worse than just paying rent. You are paying rent to the landlord who is actively trying to evict you and steal your business.
Very true.
I mean, Google has BigQuery, Amazon has Redshift. These hyperscalers have their own competing data warehouse products.
Wow.
What prevents Amazon or Google from simply jacking up the infrastructure fees to squeeze Snowflake's margins or, heavily subsidizing their own competing products to steal Snowflake's clients? How is this not a fatal flaw?
It is a profound risk. But Snowflake defends against it through a multi-cloud strategy. Snowflake is uniquely engineered to run seamlessly across all three major hyperscalers, AWS, Azure, and Google Cloud.
Okay, why does that matter?
Enterprise clients love this because it prevents them from being locked into a single vendor like Amazon. If a Fortune 500 company builds directly on Amazon Redshift, they're completely captured by Amazon.
Right.
But by building on Snowflake, the enterprise remains cloud agnostic. They can shift workloads between Amazon and Microsoft behind the scenes without rewriting their data architecture.
Oh, that's clever.
And the hyperscalers tolerate Snowflake because, at the end of the day, Snowflake ultimately drives massive underlying compute usage to their data centers. It is a fragile but highly profitable symbiosis.
Symbiosis or not, that margin pressure brings us to the final bear argument, the valuation multiple. Even after this 30% drop, looking at a stock near $174, this is not a cheap company.
No, it's not.
It still trades at a premium price-to-sales multiple of 8.66.
Right. And a price-to-sales multiple of 8.66 means investors are currently willing to pay $8.66 for every single dollar of revenue the company generates over the next year.
And just for context, the average stock in the S&P 500 trades at a price-to-sales multiple closer to, 2.5 or 3.
Yeah, so it's a huge premium.
Paying nearly 9 times revenue means the market is still demanding near perfection. It implies that massive sustained future growth is already baked into the current stock price. If enterprise adoption of these new AI tools slows down, or if the hyperscalers successfully squeeze their margins, that 8.66 multiple could easily compress to 5 or 4.
Absolutely.
Which means the stock could still fall significantly further, regardless of the $10 billion backlog.
The valuation risk is very acute. If the monetization of these AI features lags behind the current macroeconomic hype, the stock will suffer multiple compression.
So, knowing these substantial risks, the efficiency paradox, the hyperscaler rent, and the demanding valuation we need to evaluate the immediate horizon, what are the specific catalysts over the next 90 days that could trigger a reversal in momentum and actually validate the bull case?
Well, the most explosive potential catalyst involves the rumor mill regarding deep infrastructure integration.
Oh, the OpenAI rumors.
Exactly. There are highly credible reports circulating of a $200 million multi-year deal involving Snowflake and OpenAI, specifically focused on the upcoming GPT 5.2 architecture.
Wow. If a $200 million infrastructure deal with OpenAI materializes, that completely changes the narrative. It would functionally crown Snowflake as the absolute default infrastructure layer for enterprise AI agents.
And we really need to define exactly what that means for the listener, because the shift toward agentic AI is the core of Snowflake's future monetization.
Right, because most AI right now is just chatbots.
Exactly. Currently, most enterprise AI usage is prompt-based. A human asks a chatbot a question, and the chatbot generates an answer. It requires a burst of compute, but it is finite.
But agentic AI operates differently.
Very differently. Agentic AI involves autonomous systems that execute complex, multi-step workflows without constant human prompting.
Can you give an example?
Sure. For example, an agentic AI might constantly monitor global supply chain data, identify a potential semiconductor shortage in Taiwan, autonomously contact suppliers, negotiate a bulk purchase order, and update the company's enterprise resource planning software all in the background.
That's incredible. But it must take a ton of power.
That's the key. The amount of continuous background compute power required to run autonomous agents is orders of magnitude higher than a simple chatbot.
So if Snowflake becomes the default infrastructure for agentic AI, their consumption-based revenue will absolutely skyrocket.
Exactly. And we are already seeing institutional sentiment shifting in anticipation of this. Several major analyst desks have recently upgraded the stock to a speculative buy
Based on the AI potential.
based on that, and they are pointing directly to the $9.77 billion RPO backlog as a safety net. They see the early signs of this agentic AI monetization as the real growth engine.
So they're basically saying the sell-off was overdone.
Right. They are making the calculation that the 30% punishment the stock has taken simply does not match the accelerating fundamental reality of the business.
And the macroeconomic environment is also shifting in their favor, right?
Yeah.
Federal Reserve Chair Powell has recently been downplaying the likelihood of further interest rate hikes.
That is a huge factor. For high growth, high multiple software stocks, the interest rate environment is like gravity.
How so?
When rates are high, the future cash flows of a company like Snowflake are heavily discounted by institutional models, which compresses the stock price. But if the Fed remains dovish and holds rates steady or even cuts them, it relieves that pressure.
It creates a highly favorable environment for software multiples to expand again.
Precisely.
So, tying these catalysts to the calendar, the listener needs to track two major events. First, Q1 fiscal 2027 earnings, which will hit in late May or early June. The entire thesis really rests on whether they can maintain that 30% product revenue growth.
Yeah, that's the proving ground.
If they demonstrate that the AI adoption is genuinely driving sustained consumption, the market narrative will violently shift back to the bull side.
And following immediately after earnings is the Snowflake Summit 2026 in June. Historically, their annual summit is the major launch pad for significant technological capabilities.
What are we expecting this year?
The industry expects them to move their agentic AI tools from early access testing into full enterprise production. That summit is the prime environment to announce major partnerships, perhaps even that rumored OpenAI infrastructure deal.
Which would serve as the ultimate narrative catalyst.
Absolutely.
Bringing the entire analysis together, we have weighed the massive 30% revenue growth, the operational leverage driving 11% margins, the $10 billion contracted backlog, and the massive transition to an agentic AI operating system.
Right.
And we have measured that against the consumption efficiency paradox, the existential threat of hyperscaler rent, and the premium valuation multiple. So what is the final objective investment thesis here?
Well, the quantitative and qualitative setup yields an 8 out of 10 bullish score. However, the critical caveat for any investor is that this is strictly a long-term hold.
Meaning a horizon of 12 months or longer.
Yes, 12 months or longer. It will require several quarters for that massive $9.77 billion RPO backlog and the newly launched agentic AI workloads to fully materialize into recognized revenue.
The market needs time for the consumption metrics to outpace the short-term efficiency headwinds we talked about.
Precisely. It is not a day trade. It requires the patience to let the fundamental mechanics play out.
But the 30% year-to-date drop does offer a rare, highly asymmetric entry point.
It really does. You are acquiring a company growing top-line revenue at 30% with a deeply entrenched enterprise moat at a massive discount simply because the broader market is hyper-fixated on short-term optimization noise rather than the long-term architectural lock-in.
As the artificial intelligence revolution accelerates, the physical and digital infrastructure housing becomes completely invisible to the end user, yet absolutely indispensable to the global economy. When you look at the future of the technology sector, ask yourself, will the ultimate generational of the daily headlines, or by owning the silent, inescapable data vaults charging rent underneath it all? Thank you for joining us for this analysis.
Until next time.